Hello, and thank you for joining us for this Central Valley Housing and Economic Update for the week of July 30th. My name is Jordan Levine, Deputy Chief Economist here at the California Association of Realtors, and I'm bringing you the good, the bad, and the ugly of California, and more specifically, the Central Valley's economic and market recovery. On the good front, we have seen significant progress been made on the economy in general and the housing market specifically. One of the things that's most encouraging is just how strong the demand is out there from buyers. But indeed, we are seeing this also play a role in our members' businesses, and realtors in our weekly survey have been reporting increased levels of optimism, almost irrespective of the indicator that we ask about. The bad news is that our lack of inventory, which has been a problem going back even before the current crisis, is starting to really impede our ability to grow at a more rapid pace. And indeed, we see that although realtors are more optimistic about what's coming down the pike for the future, we do see them actually reporting weaker numbers in terms of what's happening on the ground right now. And indeed, when we go into the MLS data, we can see that closed sales have started to dip. Now, a little bit more in terms of the kind of negatives out there, when we look forward, there are several key indicators which have indeed moved in the wrong direction. And when we drill that down into what's happening for the housing market, some of our forward-looking indicators on housing, particularly in the Central Valley, show that the pace of the recovery that we've enjoyed up till this point is likely to continue to slow. And that's particularly true as the level of uncertainty and the downside risks for the economy and the market have grown in recent weeks. But let's talk about the good news, right? Because when we look backwards, things have improved significantly. Indeed, when you look at California's housing market, labor markets, we had an unprecedented gain of more than 500,000 jobs created or added back in June. We've still got a long way to go, but that's one of the biggest increases ever recorded in terms of California's labor markets. I didn't bring the unemployment numbers, but those are down by several percentage points as well. And so folks in California have started to get back to work for the last couple of months. Also, critically, we see that retail sales, particularly once you strip away auto sales, and we know that cars haven't come all the way back, but if you look at retail minus food and automobiles, what you can see is that consumers, who represent 70% still of the overall US economy, have come back to pre-crisis levels of spending. And so again, as go consumers, so goes the economy. And so this resurgence in spending is absolutely critical for our recovery and a good forward-looking indicator that suggests that consumers have started to bolster business activity again. A little bit closer to home, we know that rates are at all-time low levels. In fact, at this time last week, we were down at a 30-year fixed rate mortgage, which was below 3% for the first time in recorded history. And the reason why that matters so much is because of what it does to our clients' monthly mortgage payments. And so if you look at our numbers from June, which we just released last week, the median priced home actually set a new all-time high level of over $626,000. But if you look at the payment on that home, taking into account these historically low interest rates, the principal and interest payment on that home is $2,160 per month. Now, if you wind the clock back to around 2018, when interest rates were almost 5%, we saw that the median priced home, which was actually a cheaper home back then, actually cost in terms of monthly principal and interest $2,460 per month. And so you can actually get a more expensive home today for less money on a monthly basis than it cost you a few years ago. And in fact, that $300 worth of monthly savings, in some cases represents like the cost of a car payment, but over the life of a 30-year loan, that's over $100,000 worth of savings that consumers are going to be able to enjoy just purely because of these lower rates. And therefore, it's perhaps unsurprising that even though we had a weekly decline in the number of new mortgage applications on the left-hand side, you can see they were down by about 1.4%. If you compare us to where we were at this time last year, when there wasn't unemployment, we weren't in the midst of a global pandemic, we're still running about 20% ahead of last year's pace in terms of buyers actually wanting to take out a mortgage so that they can get a foot on the property ladder. And indeed, when you look at the numbers for June, you can see that we clawed back almost all of the lost sales that occurred during April and May for the Central Valley. In fact, with that monthly growth, the Central Valley ended June just 1.5% below where we were in June of 2019. We're still 12.5% roughly below where we were through the first 6 months of last year, but we have regained significant chunks of that lost ground. In addition, we see that prices are rising by almost 7.5%. Unsold inventory has actually dipped down lower than the statewide average. And so for the Central Valley as a whole, there's only 2.2 months of unsold inventory on the market at this point in time, which is perhaps the reason why we're seeing homes sell so fast, with a median time on market from list to pending of just 14 days, and sales to list price ratios that are still at 100%. So effectively no discounting happening in the Central Valley. As the economy has started to heal, rates have fallen, folks really want to jump back into that housing market, and we see that showing up in June's housing data for the Central Valley. And realtors are feeling good, right? And you look at our weekly survey of realtors, which just concluded on Monday, you can see that across the board, whether we're talking about listings, sales, or prices, realtors are feeling more optimistic that those things will be growing this week than was the case even as recently as the week prior. So that's the good news. The bad news is that our lack of supply, which we've talked about at length prior to the crisis, is starting to really impede our ability to grow. So if you look at the statewide number, active listings were down 44% almost from where they were at this point in 2019. When you zoom it in to the Central Valley, what you can see is that we really haven't had any noticeable growth to speak of in terms of new listings coming onto the market after that kind of resurgence that we enjoyed throughout April and into the first week of May. But really over the course of the last 2 months, no noticeable growth to speak of in terms of new supply coming on the market. And in fact, we've been down in 2 out of the last 3 weeks locally in terms of new active listings. And therefore, after that initial wave of new inventory came onto the market, and we were able to get buyers into those homes, we've really seen essentially flatness or a plateauing of pending sales. And in fact, we've seen pending sales decline in the most recent week of data. And so again, I don't chalk this up to a lack of demand. I showed you the mortgage applications. I could have showed you the requests for private showings, which show very similar trends. And yet this lack of inventory is really inhibiting our ability to grow pending sales, which again have been flat for the better part of the last 6-8 weeks. And that is leading to closed sales, which are actually down for the second time in the past month, right? And so we enjoyed a nice robust recovery that really bolstered the June numbers. And in fact, the pending suggests that July and potentially even August will also be good months for the Central Valley. But eventually this lack of supply is going to start to catch up. And I think we're seeing the initial signs of that here in the closed sales for the Central Valley market. Realtors are also reporting more difficulties in their business, right? Fewer reported over the weekend having a listing appointment last week. We actually had a slight increase in the percent of realtors that entered escrow last week, but in general, these numbers are also down from where they were about a month ago. And we had fewer realtors last week actually closing a transaction, just 21%, which again was the lowest level that we've seen in about a month. And so, that supply issue is really inhibiting our ability to grow as robustly as we could. And on top of that, we've seen over the course of the last 2 weeks, the amount of uncertainty and downside risk grow, and also just more evidence of how far or how deep the hole is that we still have to climb out of. Indeed, when you look at the medical side of this, we can see that the number of cases and the number of deaths are rising. And the reason why that matters for the economy is that we've had to start to clamp back down on business activity. And indeed, that has started to filter through to the broader economy in general. We just today got the release for second quarter GDP, which shows that the economy contracted by 33% last quarter. That's the biggest decline in recorded history. And so even as things have started to move forward in June and July, again, just a lot of healing left to do, big, deep hole still to climb out of, even as things have moved in the right direction. And you can see that in terms of the labor markets, that we've added back about 7.5 million of the jobs that we lost during March, April, and May. And yet we still have about 15 million jobs to add back to get back to our pre-crisis level. So we've made tremendous progress, but still got a long road ahead of us from a labor market standpoint. And indeed, as COVID has started to ramp back up, and business has shut back down, we've actually seen the number of jobless claims increase 2 weeks in a row after 14 weeks of consecutive declines. And here in California, we're actually on the leading edge of that, with an increase in new unemployment filings in 6 out of the last 10 weeks. We're miles ahead of where we were back at the end of March, but we are seeing the number of folks losing their jobs actually increasing and moving in the wrong direction. And that will have multiplier effects, ripple effects for the broader economy and eventually for housing. And indeed, we're already starting to see that impact consumers. We talked about how consumer spending is so important because it represents 70% of the economy overall. Well, after 2 months of improvement, we actually saw consumers get less confident again as job loss ramps up and uncertainty increases. And so perhaps the more ominous sign is the fact that not only are fewer homes going into escrow, we're also seeing a bigger percentage in our weekly data actually falling out of escrow. Some of this is COVID related, but some of it's just economic hardship, job loss, lost income, that kind of thing. And they haven't risen to alarming levels, but we have seen a steady march upward in terms of the percentage of transactions falling out, which are now at 7% compared to about 5% back in late May, early June timeframe. And so to summarize, I would say that we have made tremendous progress. You see it across many indicators: non-farm employment, unemployment rates. We see it in consumer spending, which has started to come back. We see it in several different measures of buyer demand, and we even saw it play out in our monthly press release for the Central Valley during June. All of that being said, we still face ongoing headwinds. And so even though we are still on that road to recovery, we've got a long road ahead, and it is proving to be filled with twists and turns and bumps. And so again, things have improved tremendously, but we've still got a lot of healing left to do in the Central Valley. And so we will go ahead and leave this one there. Thank you so much for tuning in for this Central Valley economic and housing market update, and we will report back in a few weeks with anything that changes.